So here we are. Let's talk about what's happening in the markets. I'm just showing you at this moment Zillow, but you can take this back and see most stocks today are well off their highs. These are the four broad US indexes. You could look at what's happening there. I could type in any number of stocks. But ultimately, what I wanted to show you was that the day trader army loses all the money it made in meme stock era. This is something that I have talked about over and over and over again as we saw the ridiculousness through 2020 into 2021 really taking effect. And then you move forward into 2022 and things look a lot different. Many people didn't want to believe it, but this is where we're at. Diamond hands mentality fuels dip buying and now faces test. Capitulation from the crowd may help signal a market bottom, right? Because everybody seems to be bearish today, so perhaps now is the time to get in. There is one different aspect of that, and if you stay with me for just a couple minutes, I will show you why something is very different. It's ending fast as it began for retail day traders whose crowdsourced daring was the preeminent story of equities over the past couple of years. Nursing losses in 2022 that are worse than the rest of the markets. Amateur investors who jumped in when the lockdown began have now given back all of their once prodigious gains. You could see here that this is done by Morgan Stanley. You don't need to do that though. You can just go to any number of stocks. Look at the famous ones. Look at the big names. And almost every single one of them are down. The calculation is based on trades placed by new entrants since the start of 2020 and uses exchange and public price feed data to tally overall profits and losses. So they're not looking at the stocks necessarily, but they are looking at those who have simply entered the market as of 2020, because these people here are new to the whole game. And as a result, you can see what they've been doing. And they went on Reddit and they started to gather together and they got into things like GameStop and they got into things like AMC and they got into Peloton and other names, right? Some of those are up from their absolute bottom. A lot of people got in at a point in which they are still underwater. Okay. So we don't know what's going to happen. And obviously, there is excessive bearishness measured by any number of indicators, whether that's using Goldman Sachs indicators, bullish and bearishness. I mean, there's so many different factors, but you ultimately have to understand what's been happening. And like I said, hang in for there for just 1 minute. I just want to make my point. A lot of these guys started trading right around the beginning of 2020, so their only investing experience was the whacked out Fed fueled market. That all changed with the Fed pivot in November, but they didn't realize that because they've never seen a market that wasn't supported by the Fed. The results have been horrific. Estimated profit and loss of all retail flows starting from January of 2020. So imagine this, you invested at the bottom 2020, you timed it perfectly. You are now back to where you started. And that's if you just did okay. All right. So a lot of people are worse off. Imagine that. And that's if you timed it at the absolute bottom. Now, of course, those holding Tesla are probably pretty happy. But we have to understand that, well, I guess some people probably threw all of their money into one stock. But anyway, just for most people, they're investing into a basket. They're investing into various stocks, the ones that they like. AMC down 78% from June 2021, Peloton, and they mention others. This is important. Fed hiking cycles end with deleveraging events. What you can see right now is the Fed funds rate. You measure this going all the way back over 100 years ago, and you can see always the Federal Reserve continues to increase, and at some point, the market pops, the bubble pops. And this happens over and over and over again. So they just keep increasing, and then suddenly, we've got a problem. And they kind of, if you notice, a lot of these tops, like this one right here, 2008, it's kind of this moment where it's saying, okay, we're going to stop that. And then suddenly it turns around. Okay, so we've noticed that a few times before, back in 2018, back in 2008. and as well as 2000. It depends on the length of time, of course, but generally that's the way it works because they start to say, uh-oh, we've got an issue here. This is the average S&P 500 6-month return, 1950 to present. And essentially what they're trying to say here is that from May to October is historically the worst returns. May to October. Is that the case this time? Well, it doesn't give us any indication, but it's just showing you over the last 70 years, May to October is generally the worst period. Look at what's happening with the jobs. Like you can look at what's happening with inflation. I'll talk about it in a second, and that is so key. But this is just showing us the jobs market: 5.6 million more job openings than unemployed people. I mean, you've just never seen that before, and it gives us pause. It gives us a moment to really reflect and realize this is a very different market. This is a very different economy than things we've seen in the past. So we should be aware of that. The measurement of inflation can be done in many different ways. This is trueflation, TRU-flation, and I like it because it uses thousands and thousands of different data points, puts them all together, and this is consistently being updated, like literally every single day. So it's a cool measurement, and right now it's showing us for the United States 11.4%. What the real rate is, I mean, it all depends on you, but I just like to look at this simply to highlight the fact that it's excessive. Okay. Look at it over the past year, what's been happening. Look at what's going on. It's going up, it's trending up. Now, that could come down, but that's possible. But it's been happening for so long here that the damage is really being done. It's not transitory. You remember that? I mean, how funny was that? Transitory, transitory. How many people were repeating that? I mean, it just made me sick. Peak inflation and Fed policy, a relationship which should worry the Fed and scare investors. I don't think it worries the Fed because I know that they know exactly what's going on. But anyway, this is just an article, and I found it very, very interesting, and I'll just sum it up for you really quickly. It's that every single time we have a bout of inflation, when it comes up, the Federal Reserve has to increase interest rates beyond that level of inflation in order to get it down. So think about that. We are at this, let's just say 8% inflation, what they measure. Let's say 8% inflation. Are we going to see 8% Fed funds rate? Like, is that really going to happen? Does anybody believe that? I mean, anything is possible, I guess. I mean, maybe pigs can fly. I don't know. Okay, I've never seen that before, but maybe there's a way. And so essentially what he's saying is that, it would take 6% or more to get inflation under wraps based on many factors. You can read it here. Is that going to happen? I don't know. And of course, brings me to my next topic, which is food. Food prices are historically at a record high. Nearly 25 million tons of grain stuck in Ukraine, according to the UN Food Agency. But you see it all over the place. This is happening. We are watching extreme tightness in these markets, and this happens to be just one factor. Okay, it's not just Ukraine, but all over the world for one reason or another. Speaking of Ukraine, Western banks prepare for $10 billion hit in a retreat from Russia. So we see many different companies, financial institutions, you see all kinds of different businesses, oil companies, and so on, that are basically pulling out of Russia. Whatever your opinion is on this, I think in this case here, all I want to focus on is the financial aspects, and these companies are going to take a hit. That means their corporate profits are going to take a hit. That means if this does reverberate and we see that shockwave, this could mean maybe some job cuts, not just in those local areas where we're employing people, but maybe that comes back home as well. Okay, really quickly, I want to show you this information related to China. Stop asking why. Shanghai tightens the lockdown, Beijing keeps testing. So essentially, with that reference of stop asking why, basically just means that the people in the hazmat suits are telling the people just do what you're told, and that's the end of that. New China home sales tumbled 33% over these 5-day national holidays over the past year. Okay, and that's generally not a good sign. China's stimulus fails to ignite housing sales over key holiday. Top leaders make a U-turn in policy to boost home sales. I've noted the reserve ratio requirements that have been decreased, the stimulus efforts that have been done, and yet they have not been able to get people to buy homes because people right now are concerned. They don't know what's going on. They've got inflation to worry about. There's lockdowns happening. And so that's just not going to occur. Okay? So we will see what happens because I'm seeing China going in a very different direction than most other central banks around the world. Transactions fell in most cities during the 5-day Golden Week. And then last but not least, China's massive community buying industry is collapsing. I thought this was interesting. I wasn't aware about this. The government has soured on the tactics of tech platforms that help neighbors buy groceries at bulk rates. So imagine being able to crowdsource this, that you would have this tech company that simply buys in bulk, massive amount in bulk for a particular community, and then you share from that. So you're getting a discount rate and you're able to do that through these different tech companies, right? So I guess they make a commission on that, and everybody's happy because everybody wins. Now they're cracking down due to some different issues, but I just see it as more crackdowns that are coming to not just the tech companies, but it seems like China is doing this on many different companies, and that will, of course, weigh on the stock markets. Okay, so that's it for this video. If you appreciate it, give me a thumbs up. Didn't do the whole intros, no cutscenes, no face. We'll just see how it goes. Okay, thank you for support.